right, welcome everybody. Can everybody hear me?
Yes, we can hear you.
Okay, great. All right, then let's get started. I'm going to share the screen. And first, I'll just briefly go over some of the midterm statistics, which were actually pretty good. So let me hide this. So here were the midterm statistics. Average score 83, which is quite good. So that was good to see. A lot of people did quite well. As I looked through the problems, there weren't any problems that really stuck out a lot as people missing. This was maybe the most extreme, which was more of a conceptual one. Binomial option pricing theory is based on, and this is just going back to how we derived it, that notion of the risk, creating a risk-free portfolio. And that was the answer there. But otherwise, there weren't any problems that seemed like they were really, really killer problems. So I'm not going to spend time going over every problem here. I did open it up, so you should be able to see it. And I opened it up through Wednesday, so you can go in and you can look at your answers. And I think it shows the correct answers. Hard part is I'm never able to see exactly what you guys see, which is always frustrating. So I'm always sort of guessing at some of the settings. But I believe I opened it up so you can go in and you can check your answers and compare it to the correct answers in there. But overall, good results. This was higher than the first midterm, and so that was good to see. Let me just jump over to the web page before we get into the lecture today. And I don't know that I have anything new on the web page right now, but just some things that'll be coming up. So homework, watch for a new homework. We're going to start into the Black-Scholes model today. Black-Scholes, that was sort of the big one that started everything. We do it in a little bit reverse order here because we did binomial lattice, which is easier to understand. And then we're going to go to the Black-Scholes model today. So I'll post a homework on that pretty soon. But that'll probably be due after the Thanksgiving break. When we come back after the Thanksgiving break, we got about 2 weeks just to get a general timeline. We're going to go through the Black-Scholes model, hopefully this week. We'll see how much time it takes us. And then we're going to get into forwards and futures. So that's the other part of the course. We'll see forwards and futures are conceptually easier than options. So that hopefully won't be too bad. And that'll, I think, pretty much take our time till the end of the semester. So that's our plan there. All right, so watch for that new homework when I post it, but it won't be due before the Thanksgiving break. It'll be due after that, so you'll have some time for that. All right, let's, and by the way, on the exam, if, take a look at your exam. If anybody has any questions, feel free to join me at office hours. I'm happy to go over problems with people. Okay, so let's jump back to the lecture. We just got through binomial lattice. We completed all that material. Binomial lattices are a really nice model. They're a simplification. Like I said, if you look historically, what happened was the Black-Scholes model came first. And then it was only after that that the binomial model came about as sort of a simpler explanation for that. And by the way, I hope people watched the video, the Midas formula. I thought it was really well done. It was done in a pretty good manner. It made it kind of interesting. And hopefully you picked up on some of the concepts there that they made pretty dramatic, but that we went through with the binomial lattice, like creating that, risk-free portfolio and stuff like that. So I thought that was really well done and pretty interesting. And then if you also saw the backstory, hopefully everybody watched it. But if you didn't watch it, just that the backstory about Scholes and Merton, and that's Scholes of Black-Scholes. Black passed away fairly young, so he wasn't around at that time, but Scholes and then Merton also got the Nobel Prize for Black-Scholes option pricing stuff, sometimes called the Black-Scholes Merton model because he was very influential, but they were involved in that hedge fund long-term capital management, which was doing phenomenally well and then just collapsed, right, and had to be bailed out. And so it's pretty interesting story there. Okay, so that as the backdrop, let's move this down to the bottom. Let's jump into the Black-Scholes model, and let's see how it relates to what we've seen so far with the binomial model. And so if you're following along in the book, this is chapter 5 of the book. Okay, so you can get some of the material from a different perspective in chapter 5. All right, so I'm going to call this chapter 5, and this is the Black-Scholes model. And this is the model and the name most affiliated with option pricing theory. This was the theory that got the Nobel Prize. Like I said, this is the one that came about first. Later, the binomial model came about as sort of a simpler explanation for it. And the binomial model is very nice too because it was more flexible. We saw that you can do American early exercise. You can add dividends into that. And so the binomial model is really nice. But let's see here, there's actually a pretty short hop between the binomial model and the Black-Scholes model, which was the original model. And it was a little bit of background. Black-Scholes model was derived in a pretty complicated way, using what's known as stochastic calculus. So if you've seen calculus, you can imagine stochastic calculus. And so it was pretty complicated. And that's actually, Black was a physicist, so it was very mathematical. And then Merton, who was in the video that you saw, Merton was very good and sophisticated mathematically. And he was familiar with the so-called stochastic calculus. And so he did a lot of contributions, but it was derived in a manner that was pretty tricky. They got a partial differential equation, and they ended up solving the partial differential equation. Very complicated. Nowadays, like I said, we've got the binomial lattice, and the binomial lattice really gives us a much simpler approach to getting to the solution. So what we're going to do here is I'm just going to show you the short hop from the binomial model to the Black-Scholes formula. All right. So with that as background, let's jump into it. Sorry, my handwriting doesn't seem to be so nice. So the Black-Scholes, sometimes called the Black-Scholes Merton. I'll probably just use Black-Scholes, but I'll tag Merton on there because he was given the Nobel Prize for this along with Scholes for some of the work on this. So he's a name you should associate with it. So this is the limit of the binomial lattice. And I'll show you what we mean by that. We know that we did everything with the binomial lattice. Let me remind you of the binomial lattice picture. So here's our simple binomial lattice picture. And we have C0, we've got the price of a call at the beginning. We've got our risk neutral probabilities, P and 1 minus P. Those are the up and down risk neutral probabilities. We had the value of the call in the up state. We have the value of the call in the down state. And of course, these correspond to the movement of the stock. And let me remind you of our binomial pricing formula, or the risk neutral pricing formula. It was 1/1 plus R. And then we had P. Actually, let me make sure this looks like a small p. So that was the risk neutral probability of moving up. What was the value of the call in the up state? C sub U plus 1 minus P C sub D. There was our formula. And the key connection that I'm going to make, this was the formula that we used, but if you'll remember at one point when we went through the binomial lattice, I tried to relate this to an expectation. Now, if you're not comfortable or familiar with expectation, that's fine, but I'm going to use that as the connection with the Black-Scholes formula. So one way you can actually view this formula, and this was the so-called risk neutral pricing formula, was as the expectation of what did you do? You took the payoff of the option at expiration, that's C sub T, and it was the expected payoff. And then we discounted it here, but I'm going to focus on this part right here. So this was the expected payoff, right, of the option using the risk neutral, remember that's what P and 1 minus P, using the risk neutral probabilities. Okay, we had that, and then so that was one aspect to the solution, and the other aspect here was that we took that expectation and then we discounted it. That's the 1 over 1 plus R. We discounted it by the risk-free rate. Okay, and the fact that we were just to remind you of some of the terminology, the fact that we were discounting it by the risk-free rate, we were treating it as if it were a risk-free quantity. You know, that's like a present value calculation where you have a risk-free quantity and you discount it by the risk-free rate. That's why we call it risk-neutral pricing, because it's somebody who says, I don't care about risk, I'm neutral to risk, and I'm just going to treat everything as if it's risk-free. And so when I discount, I'm going to use the risk-free rate. All right, so we're going to take off from this point right here, from this formula, and we're going to see what happens to this formula as I take the limit of the binomial lattice, and that's going to lead us to the famous Black-Scholes formula. So let's write this down. So when we take the limit of the binomial lattice, I'll show you this in pictures in a second. That is sloppy. So I'm going to take the limit of the binomial lattice as the number of steps goes to infinity. We get a continuous model. Show you the picture of this. So here's the picture. We've got our binomial lattice, but what we're going to do is we're going to do many, many steps. Okay, like if you did the extra credit, you did a 10-step model. As I mentioned in practice, if you're using the binomial lattice, you're likely going to do at least a 200-step model. You're probably going to, you might do it in Excel, but you might not do it in Excel. You might do it in some other language that handles that calculation a little bit better. But here's the idea. You know, we started at time 0. This was expiration, and we did n-step binomial lattice. And then the question is, you know, n could be 10, n could be 200. What if I take the limit as n approaches infinity? So 200, 2,000, 200,000, 2 million. I just keep on taking more and more steps. Same time period, this can be, you know, a month or something like that, but I just take smaller steps. And what you're going to get is you're going to get a continuous model. So it limits out, and this is by, I mentioned this before, the central limit theorem. Central limit theorem says if you add up a lot of random things, it's going to look like the normal distribution. And so here I'm adding up all these little steps, and say you're going to get a model that looks like this, where the stock just grows. I'm not doing the best, sorry, picture of this. But the idea is that the distribution of where the stock can move just spreads out over time. And in the limit, it becomes that normal distribution that we had. And it's a normal distribution with standard deviation, which we called sigma. And so we get a limit there. So the binomial lattice here, oops, what does it limit at? It limits at a normal. I always learned to call this the Gaussian, but I guess here they call it the normal distribution. Okay, so that's our connection. We're just going to take the binomial model, which we understand well. Like I said, if you did the extra credit, you did 10-period binomial model. Imagine doing 100-period, 1,000, million, 100 million. Just take that limit and what happens. And so mathematically, you can show that you get a process for the stock price, which looks like it evolves according to a Gaussian distribution. Okay. So that's the first thing that we're going to use. This is going to be a one step that we're going to take. Let me mention another thing before we do sort of the final hop to the Black-Scholes. Another thing that we're going to have to deal with, which is a little bit annoying. It's annoying actually because of the way the book did it. The book didn't have to do it this way, but I'm following along so that those that are reading the book aren't going to get confused by different notation. And here's the other thing. So Black-Scholes uses continuous compounding for the risk-free rate. Okay, what does that mean? That's just the way we do the present value calculation. So let me show you sort of the two elements that are going to come into play here. So the first is in the Black-Scholes, you've got to take an expectation, and you've got to take an expectation of the payoff of a call option, and you're going to do it under the risk neutral probabilities. And the first step there is that how do you do that expectation? You have to have a distribution, and the distribution as the limit of the binomial lattice is going to be a normal distribution. So you got to take an expectation with respect to the normal distribution. We'll see how that's done. That's actually a messy calculation I'm not going to go through all the details of, but that's one step. The other thing we have to deal with is right over here, and that's the discounting. And when it was doing the binomial lattice, the convention that the book used was what we call discrete compounding, or they use annualized interest rate or a per period interest rate. But the Black-Scholes formula always uses continuous compounding. That's just a convention, but we've got to switch to that convention in order to get the correct Black-Scholes formula. So let me remind you, hopefully this is a reminder. You might have to, I don't know if you'd see this in 320 class or something like that, but hopefully this is a reminder. So in annual compounding, so this is what we were using before. We had the following. So we had a picture like this. I'm going to use my cash flow diagrams. We had X, and then if you compounded it out to time, capital T, it became what? X1 plus R to the T. Okay, so that was our annual compounding. That's what we were using before. That's not the convention that Black-Scholes formula uses. So let's see what Black-Scholes uses. So in continuous compounding, now this is what Black-Scholes formula. In continuous compounding, we're going to use, and I'm going to use the notation R sub C to be the interest rate under a continuous compounding convention, and that's the sub C, just to distinguish it. We use R sub C to represent the risk-free rate. And here is what compounding looks like. Now, again, I hope you got a chance to see this, maybe in a 320, but under a continuous compounding convention, when I compound an amount X and I compound it out to some time capital T, then it becomes X e to the, and you use the continuous compounding rate multiplied by the time period. Okay, so it's e to the RT. So I hope this is something that you were introduced to in, maybe it would have been a 320. If not, it's just a convention. So this is the way we compound, and I'll also show you, let's do a little example, a discount example. And so that we'll all understand it. Let's do a little example. All right, so let's do a present value, because that's what we'll need to do for the Black-Scholes formula. So what is the present value of, let's take $100, okay, in 6 months under, let's take that continuous compounding rate to be 5% compounded continuously. Okay. So there we go. This is just a simple present value calculation, but just illustrating continuous compounding, which is the convention used in the Black-Scholes formula. So again, I like to always draw pictures for my cash flow diagrams. And so this, it was at 6 months, what was it? There was a cash flow of $100. And all this is asking us to do is saying, just calculate the present value of that, but we're going to use continuous compounding. Okay, so what is the formula? So our present value of that $100 would be 100. Here's the formula E. And in this case, because we're discounting, not compounding, it's E to the minus R sub CT. This can also be written as, and if you do see this in 320, I don't know which way you see it. It can also be written as this: 100 divided by E to the R sub CT. And let's do the calculation here. I tend to use the one where it's not in the denominator, but you can do either one. But let's do this calculation. So minus, what is R sub C? It's 5%. What is time? Again, we always measure time in years. So it's a half a year. 6 months is a half a year. And you do that calculation, and hopefully I did that right, but that's 97.53. So that's how we do present value or discounting. under a continuous compounding convention. Okay, and so that's what the Black-Scholes formula uses. I find it annoying, just a side comment, I find it annoying that the book, when it did the binomial lattice and other calculations, didn't put call parity. When we had to discount things, it used annual compounding and an annual interest rate. But then when you go to Black-Scholes, Black-Scholes is always done with continuous compounding. So if it were up to me, I would have just started continuous compounding everywhere. I don't care if it was the binomial model or put call parity, because compounding is just a convention. And so it doesn't matter how you do it, as long as you do it consistently. So the fact that they did it one way and then they make us change, I don't know, that bothers me. Okay, anyway, this is the way we calculate a present value. Okay. All right. So now we have everything we need to get the Black-Scholes. So let's head back to Black-Scholes. All right, so Black-Scholes. Black-Scholes, we always use that continuous compounding approach. So we use a continuous compounding approach. And what specifically do we do? I'm going to break it down here. So let's go back and look at the formula that we start with from the binomial lattice. And this is a formula that I'm going to pick up on. And it's this formula right up here. And so what are the two things that we have to do in this formula? Well, the first thing is we're going to have to do this discounting. So the discounting, instead of doing it discretely, we're going to replace this by e to the minus RT. Okay, so that's just going to the continuous compounding convention. That's the only thing we have to do there. And then on the expectation side, we're going to have to do an expectation of the payoff of the option. We'll see how that's done. But our model for the stock is not going to be this binomial up-down model. It's going to be the continuous model. And so let me just step you through that. And then that brings us directly to the Black-Scholes formula. So you don't have to know all the details of how we got there, but I think it's good to see it and see how it connects. So that's why I'm going through this. I don't like just writing down a formula without any understanding of where it came from. So here's the first thing we need to do, discounting using that 1 over 1 plus r is replaced with just continuous compounding convention. So it's going to be replaced with e to the minus r sub c capital T. Okay, so that's just continuous compounding. So that's A, so that's the one change, that's the discounting part. All right, maybe I should write that formula up here. It was 1 over 1 plus R, and then we have the expectation of C of T. So B, here's where our stock price model comes into play. And this is the limit of the binomial lattice. Okay, so the stock price moves according to the model. So what's the value of the stock price at expiration? Again, it's going to look like continuous compounding, but we're going to have a random return for the stock price. So the stock price starts at price 0. And then if you think of the way the continuous compounding formula looks, let me just remind you of that for a second. As something grows here, if it's a risk-free rate, it's going to grow like this. We're going to multiply by e to the risk-free rate, that continuously compounded risk-free rate times t. Here, what we're going to have is we're going to have something that looks very similar, but our model is there's going to be a risky rate of return. That's the R, that's why I'm calling it R sub S, because the rate of return on the stock is not known, it's risky, it's unknown, and it follows that normal distribution. So that's our model, that's the limit of the binomial, where R sub S is a random return of the stock. And again, we're modeling the return of the stock here using that continuous compounding convention. That's why it looks like e to the RT. Okay, and that's always done in the Black-Scholes model. So it is assumed to be normally distributed. And that came from our central limit theorem up here, just our picture. Sorry to scroll back here, but that came from our picture here. That central limit theorem says if you take the limit of the binomial lattice, what do you get? You get normally distributed returns. That's what that says. So it's normally distributed. And we need to choose a standard deviation for this, just like we needed in the binomial model. With standard deviation, this is something we're going to have to estimate sigma. And remember, we called that the volatility of the stock. Okay. Just a comment about this model. So you might hear the Black-Scholes model be described as a log normal model. Okay, so let me just explain where that comes from. So, sorry, this is called a log normal distribution for the stock price. Again, this is terminology you might hear. Why is it called a log normal distribution? Let me just do a little calculation here. If you don't remember the properties of the log, that's fine. But if I take log of the stock price at expiration, here was my model up here. I'm just going to plug that in. And so that is log of S0. I'm just plugging in the e to the R sub S t. See that that's in the exponent there. And then here I'm using some properties of the log. And you might not remember this, but log of the product is the sum of the logs. So this is log of e to the R sub S t. And then log kills the exponential. So this is log S0 plus log kills the exponential here, R sub S t. And our model here is that this return was normally distributed. This was our little model. Sorry, I didn't do the picture very well, but that was our normally distributed. And so this is actually a constant, just a number, because S0, that's the initial stock price. But T is just a fixed number. So the only thing random here is this return, and that is normally distributed. And so you can see that that return actually pops out when you take the log of the stock price. So you might hear this model be called a log normal model, or Black-Scholes is built on a log normal model for the stock price. And that's where that comes from. Okay, that's sort of a little aside, but that's something you might hear. All right, so let's get to, I said it was a short hop, but now it's taken a long time. Let's get to the Black-Scholes model. Okay. So Let me start again. So we had pricing on the binomial lattice. And I'm going to show you the steps, but I won't show you all of the details because they're messy, messy details. But on the binomial lattice, we had C0 equals 1 over 1 plus R. And then we had that expectation of the payoff of the option. That was our formula. That was our risk neutral pricing formula. Now what we're going to do is we're going to take the Black-Scholes limit. And we have all the ingredients now to take the limit. Okay, so when we take the Black-Scholes limit, what are we going to have? C0 equals. And so the first thing we're going to do is this is going to be replaced by what? By just continuous convention. So 1 over 1 plus R gets replaced by E to the minus R sub C. That's the continuously compounded risk-free rate. Okay, so that gets replaced by that. And then we've got this expectation of C of T. So let's deal with that. So E to the minus R T. And then expectation, what is this? This is the payoff of the option. Payoff of, we'll do it for a call at, sorry, my handwriting is sloppy today. Maybe it's sloppy every day, but payoff of a call at expiration. So what's the payoff of a call at expiration? That's our favorite formula. The max of 0 for S sub T minus X. So we're just going to plug in for that. That's what we used. I don't have discrete states anymore. I don't have the up state and the down state. Now I just plug in the formula for the payoff at expiration. And I need to calculate this expectation. So how do I calculate this expectation? What is the random thing? Well, to do this, I know that S sub T, we just had a model for S sub T. That was our, sorry, that was our model right up here. That was our model for S sub T, and where we had this random return. So we just plug in for that. So I need to calculate this expectation where S sub T, I didn't want to do that in red, but sorry. For S sub T follows the log normal. That was just the model that we had. The log normal distribution above that we mentioned above. Okay, and so you need to do this this expectation, and you can imagine this is the kind of problem that you might have in a probability class or an ISDS class, or one of those messy ones. This one here is pretty challenging. It's a messy calculation if you want to go through it, but you got to go back and look up all your definitions of, what's the distribution of it. What's the density function of a normal distribution, and how do I calculate the expectation? So I'm going to spare you that, and I'm just going to say messy calculation, but you can look that up in places. But once you do that, that is the Black-Scholes formula. So let me give you the answer to that. After you've done this expectation, that's going to give us the Black-Scholes formula. Okay. And you'll see that it's pretty messy because you're going to see that the Black-Scholes formula is pretty messy. Okay, so Black-Scholes formula. This is a big one here, so let's highlight it. And you're going to see it's not just a little formula that I can write down on one line. There we go. So this is for a European call option, and then I'll also give you the formula for a European put option. Black-Scholes formula only works for European options. Okay, we can't do American, we can't do early exercise. All right, so here it is. So this is the value of a call option. And what does it depend on? It depends on the stock price, the strike price, the volatility of the stock, that feeds into that normal distribution, the continuous risk-free rate, and the time to expiration. Those are the things that we need to input into the model. And here's the formula, and I have to do it in multiple parts. It's S. S is the stock price. And then we're going to have what's often known as N of D1. I'm going to have to define that down below. Minus X. X is the strike price. E to the minus R sub CT. That's just a discounting. And then I'm going to have N of D2. And I got to tell you what N of D1 and N of D2 are. Okay, where? Let me tell you what D1 is. D1 is the natural log. Let me make sure I'm writing this clearly. The natural log of the stock price divided by the strike price plus continuous risk-free rate, 1/2 sigma squared, that was the volatility, multiplied by time to expiration, all divided by volatility times the square root of the time to expiration. Like I said, very, very messy calculation. This is one of the ones that you might find in a probability class if they want to punish you on a homework or something. They're going to make you do a calculation like this. So what is D2? So that's D1. So that's D1 right there. And let's look for what D2 is. So D2 is easy once you have D1. So D2 is D1 minus sigma square root of T. Okay, so that tells us what D1 and D2 are. What are those capital N's? Oh, let's tackle that. And N of X, normally it's done using sort of curly notation for the N, but I'm not very good at that. So what is N of X? N of X is the cumulative normal distribution function and that's where that normal distribution comes into play of the standard normal. And what is the standard normal? The standard normal is a distribution with mean equal to 0 and standard deviation equal to 1. Okay. So let me point you to a little more, but another way to think about this. This is the probability that the random variable X is less than or equal to little x, where capital X is normally distributed with mean 0, standard deviation 1. That might be one way that you'd see it. Or probably the more helpful way is if you go to try to implement this in Excel. This is the Excel function. I hope I have the right function in Excel. I should check that. The Excel function is norm S, meaning the normal distribution of the standard, and then dist. I hope that's right. We can check it. Okay. Not a simple formula, right? A lot of steps. We'll see. Not too bad. You can set it up in Excel. You probably can't do it on your calculator because unless your calculator has this normal, cumulative normal distribution function, you're not going to be able to do it. Maybe some good calculators have it, the calculators that I have I don't seem to have it. Actually, a historical thing, when Black-Scholes came out with this formula in 1973, and options began to be exchange traded, Hewlett-Packard, at the time, they had like the, the best calculators and stuff like that. And way back in the 1970s, they actually programmed in the Black-Scholes formula into their calculators so that the floor traders down there on the floor could actually just plug in these numbers and boom, get the Black-Scholes price. So that was really a catalyst for this as well, in making this take off. But let me highlight some parts of this. Actually, let me write down. So I have the call option up there. Let me write down the put option formula, which is based on the same thing. So I don't have to write as much. Probably thinking, oh wow, this is quite a mess. So it is, but it was a big breakthrough. So the put formula is, there's my capital P. Again, it depends on the stock price, strike price, the volatility of the stock, the risk-free rate, and the time to expiration. Those are the things that determine the value of a put and a call. And this formula here is X, the strike price, E to the minus R sub CT. And then again, we're going to have that cumulative normal distribution, but here it's going to be a minus N D2. That's the same D2 that I have up above, minus S N of minus D1. Okay, so we can use all the things that we had up above. So that's the put formula. Let me box this whole thing, and I just want to highlight some of the key parts of it so that we have it down here. Let's go down here like this. And some of the parts that I want to highlight. So here's the European put formula. Here was the European call formula. And maybe I'll do it in orange just to highlight this part right here. And of course, that's not the whole thing because you got to have D1 and D2, and you got to have that cumulative normal distribution. But I'm just trying to highlight some of the key areas in this right down here. Okay, looks like a pretty big mess. Let me give you some notes about this, and then we'll do an example so you can see how the calculations go. They're not too bad if you do them in Excel, but this was the big one. Okay, the Black-Scholes formula. This came prior to the binomial lattice, and it's considered just this huge breakthrough because nobody knew how to value these options, and they put forward this formula that made sense based on these assumptions. So very, very big breakthrough. All right, let's talk about some notes about this formula, and then I'll do an example so we can see how this is actually used, because it looks kind of intimidating. Right, it is kind of intimidating. But if you break it down into steps, it's not bad. So a couple of notes here. So A, about what you need this. All right, so that continuously compounded risk-free rate and the volatility, that's sigma, that's the Greek letter sigma. These are annualized numbers. Okay. So what do I mean by that? This continuously compounded risk-free rate is going to correspond to a yearly rate. So it's going to be some number like 5% or 3% or whatever. The volatility here, volatility, which is the standard deviation of the stock. It's the annualized volatility of the stock, okay? So those are numbers that you typically see like 20% or whatever. Later, we'll take some data and I'll show you how to estimate it from historical data, and then we'll see some other things about that, but that'll be in the lecture too. But those are annualized numbers. Okay, so that's the first thing. B, capital T, time to expiration is measured in years. And we've always been doing that. but this is just a reminder that in the Black-Scholes formula, it's also measured in years. Okay. So that's measured in years. So when you see that popping up, you know, the T or whatever here, if we're talking about 1 month to expiration and T is 1/12. Okay, it's measured in years. So T is measured in years. All right. C. All right. This is an important one. The only input, let's say I want to use this formula. I come up and I look at the put formula. Let's look at the put formula right there. So what do I need to know? I need to know the stock price. Do I know that? Yeah, I'll just look it up. What's the stock price? Strike price. Do I know that? Yep, I know that. Risk-free rate. Yep, I know that. So just look up the risk-free rate. Time to expiration. Yep, I know that. What's the one thing that I don't know? There's only one number that I don't know. That's the volatility. So that is the one that I'm going to have to estimate or get from somewhere else. So that's important. The only input that is not known, okay, is the volatility. It's the volatility sigma. Okay. It must be estimated. All right, so to use this formula, somehow you're going to have to estimate the volatility of the stock. Okay, so that's an important observation. Everything else I know, one thing I don't know in order to use this formula is the volatility. So I have to estimate how volatile a stock is. Okay, again, we'll talk about that. We'll talk about that later. And then one final note here, and this is a really important one too, and this is one that's sort of been hidden so far, so I'm going to make it more explicit right now. Okay, we're going to observe what I don't need to know in order to price an option. So the expected return of the stock is not needed. Okay, I'm going to put a star by this, right? Because this is actually a big one. Okay, let me explain why this is so big. And this is one of the other reasons for why Black-Scholes and this whole pricing theory was so influential. So let me take a moment to give you sort of the importance of this, because this is big, and you got to think about it for a little bit. Let me go back. We're going to look at the call formula up here. And so I'm trying to price a call on Tesla. Okay, let's say I'm trying to price a call on Tesla. What do I need to know in order to use this Black-Scholes formula? It tells me this is the fair price for a call on Tesla. Well, I need to know the price of Tesla. That's S. I need to know strike price. I can look up the strike price. There are a bunch of strike prices. I can just pick whichever one I want and I can use that. I need to know the risk-free rate. Okay, big deal. I can look up the risk-free rate. Time to expiration. Yeah, I get to choose that. It can be 1 month, 2 months. I need the volatility of the stock, how volatile Tesla is. Okay, we're going to see later. You can estimate that. And an okay job of estimating it. Not perfect, but not too bad. Good enough to actually get something useful. So and that's just an estimate of the volatility. It's sort of how much it can move. What do I not need to know? I don't need a prediction of Tesla's expected return, whether it's going up or down. Wow. Okay, that's big, because in order, if I needed to know whether Tesla was going up or down in order to value a call option on Tesla, I'm sort of lost. I'm back to where I'm back to sort of square one, because nobody's good at predicting whether a stock is going to go up or down, right? If you're good at predicting whether a stock is going to go up or down, its expected return, whether Tesla over the next year is going to, go up 100% or going to go down 50%. If you were good at that, you could make so much money in the markets, right? That's like the $1 million question. Nobody is good at that. Okay, Nobody is good at that. Nobody can get good estimates of whether a stock is going to go up or down. Here's the amazing part about the Black-Scholes formula and why this thing was so influential. I don't need to know that. I don't need to know that. So it says the following. I'm looking at call options on Tesla. I believe Tesla is going to go up 100% this next year. Okay. I'm going to value those call options. I value them according to Black-Scholes. I get some number. Okay. So I calculated, I get some number. Maybe you're looking at Tesla too. You think Tesla's going to go down. Tesla's going to go down 50% this year. I think it's just going to dive bomb. You go and calculate the value of the same options using the Black-Scholes formula. We get exactly the same value because the value doesn't depend on whether the stock price is going to estimated to drift up or down. That's huge. If it did, if the value of a call option depended on my prediction or your prediction of whether the stock was going to go up or down, again, it's not going to be useful. All hope is going to be lost because nobody has good predictions of those. Like I said, if you had good predictions of those, you're going to be a billionaire. You can make tons of money. So that was a huge, huge thing. And in fact, when Black and Scholes first got this formula and they saw it, they said, wait a second, does that make sense? Like, if I have a stock that I think is going to go up 100%, and there's another stock that everything else is the same volatility, but that other stock I think is going to go down 50%. My formula, the Black-Scholes formula, says the value of options is exactly the same. It doesn't matter whether the stock is going to expected to drift up or down. They saw that and they spent so much time like, does that make sense? Something must be wrong with this formula. They really struggled with it. Finally, they convinced themselves that no, this is correct. This seems to be correct. Okay, so that's a huge property of it. Just in a nutshell, and this isn't a very satisfying explanation, but in a nutshell, where is that information on whether the stock is going to go expected to go up or down? Where, because that should be embedded in here somehow. And people always say that's embedded in the current stock price, right? The current stock price reflects whether people think the stock is going to go up or down, right? Because if they think it's going to go up a lot, they're going to bid up the price, and if their predictions of that are going to be reflected in the current stock price. So if they think the stock price is going to go down, that information is already embedded in the current stock price, and so I don't need it to price an option on it. Now I don't know if that's a completely satisfying explanation. You can go through mathematically and show, like we did, it just doesn't show up. Okay, but it's harder intuitively, and that's what Black and Scholes really struggled with when they got this formula, thinking, is this formula right? So anyway, I'm emphasizing that point because if you think about that a little bit, that's a huge, huge point. If you needed to know the expected return of the stock in order to price an option on it, it wouldn't be a useful formula, right? It wouldn't be a useful formula because nobody agrees on that. Nobody agrees on which stocks are going to go up and which stocks are going to go down. So anyway, that's this last point. And this is one to really remember. And the expected return of the stock is not needed. And that really, I would say, saved this formula. And that's what made this so powerful, that people didn't need to know that. And the information that they do need to estimate, which is the volatility, think of the binomial lattice. Those are sort of the up and down numbers, where those up and down numbers are sort of how the range of where the stock can go. That's what that represents. That you can do, like I said, you can do a decent job of estimating it. Not perfect, but a decent enough to make the theory pretty useful. All right. So that's something to maybe think about a little bit. Let's do an example here so we can step through sort of all the calculations that go along with the Black-Scholes formula. It's really not too bad. If you set it up on a spreadsheet, a little Excel spreadsheet, that's a good thing to do. You probably want to do that for the homework, and maybe, I don't know how much time I have, but maybe I'll show you how to do that. All right, let's do an example. Okay, so I want to price a call and a put. Let's throw out some parameters. By parameters, what do I mean? I just mean the inputs to the Black-Scholes formula. So let's say the current stock price is 41. Let's say the strike price is 40, and I think these are, I don't know if these are exactly the same, or these are close to the numbers that I used in the 10-period binomial lattice if you did that. So we'll see how close the Black-Scholes formula is to that 10-period lattice. I should try to pull that up if I have time. Because it's the limit of the lattice, so it should be pretty consistent with that. Okay, volatility, annualized volatility, we're going to say is 30%. Okay, that's not too far off for a lot of stocks. All right, we're going to take 8% for the risk-free rate. It's high for these days, but we'll use that. And then we're going to say time to maturity is a quarter of a year. Okay, and now what I want to do is I want to value a call and a put in this situation. So what I'm going to do is I'm going to scroll back and I'm going to look at the formula and I'll try to break it down into steps. And these are steps that you could also organize like a spreadsheet into. So here are the steps that I'm going to do. I'm looking back at the formula here, and I see in the formula, I'm looking at this right over here, and I need to calculate n of D1 and n of D2. Okay, and I need to do that both for the call and the put down here. I have minus D2 minus D1. So the first things I'm going to do is I'm going to calculate D1 and D2. Okay, that's going to be my step one. Me trying to tackle this. And then once I do that, D1 and D2, then I can calculate n of D1 and n of D2 and whatever, and then I can put the whole thing together. So let's break it down into those steps. So let's go here. I'm going to call this step one. I'm just breaking it down into steps. In D1, we have that formula. It was the natural log of, and you know what, I'm going to plug directly into it. Maybe you're going to have to scroll back and forth. But I have the formula here, S over X, and then plugging everything in. So I'm just going to directly plug into those numbers. Okay, so it was S over X, so that's 41 over 40. Okay, plus, and then what was it? It was the continuously compounded risk-free rate, which is 8%. Plus 1/2 sigma squared. Sigma is 0.3, and then I'm going to square that. And then it was that whole quantity multiplied by T. Okay. And then it was the whole thing divided by sigma into the square roots of T. Okay, so I didn't rewrite the formula, but you can go back and all I did was I was plugging into D1. I was plugging into D1 here. You can go back and check that. So I plugged into that and you crunch through that number and here's what I get. I get 0.37. So that's D1. Okay, and then I'm going to D2, this is the easy one. Once I've done D1, D2 was D1. This one I can write out minus sigma square root of T. And so that's 0.37 minus sigma was 0.3. And then I have the square root of time to expiration, 0.25. And I crunch through all that and I get 0.22. Okay. So that's step one. Step one is I get D1 and D2. All right. So then let's look at it. Once I have step one, let's see what we need next. So I'm trying to build up these formulas. Once I have D1 and D2, then I need things like n of minus D1, n of minus D2. And I need up here, let's see, n of D1 and n of D2. Okay, and well, what is n? N is that cumulative N is that cumulative normal distribution function. That's the one, if you look at it for it in Excel, like I said, I don't have it on my calculator. Some of the time in probability classes, they'll have tables that you look up. I don't want to look up the tables. I would just use Excel. And so I probably used Excel for this problem, but let's do that. So I'm going to call that step 2. Step 2 is I'm going to calculate all those n's. Okay, so n of d1. Again, I try to make it sort of a curly n. I didn't do a very good job of that because lots of times it's done as a curly n. If you see it in books, it can be the calligraphy style. All right, so n of d1, that's that cumulative normal distribution function. That one's going to be 0.65. And n of d2, I didn't use that one curly, but is 0.588. And then I'm going to do n of minus d1. It's 355, and then n of minus d2 is 0.412. All right, so now I'm almost there. Let me try to make this more the curly end. I don't know if that looks any better. Okay. Okay, so now I have the n of d1, n of d2, n of minus d1, n of minus d2. Now I can go to the final step. Let's call this step 3, and I can calculate the call and the put. Okay, so the call formula, let me write this out. So it was S n of d1 minus x e to the minus r sub c t n of d2. Okay, so let's write this out down below. S was 41. N of d1, I'm just going to look up above. 0.645 minus the strike price. The strike price was 40. Now I need e to the minus r. R was 8%. Time to expiration was 1/4 of a year. So that's the e to the minus RT. And then I'm going to multiply that by n of d2. Okay. We're going to kick out an answer from this, and we're going to get $3 and my own writing. Maybe it was $3.99. I got to check this whether this is an 8 or 9 there. Maybe I can put a 9, but so that's the call, and so this says that the call price. It says Black-Scholes value for the price of a call is $3.40. Okay, and let's do a put. Do the put formula. The put formula was, and you can walk through that. It was x e to the minus r sub c t n of minus d1. Did I get that right? I'll check the formula myself. No, it's n of minus d2. Sorry about that. So this is a n of minus d2 minus s n of minus d1. Let me just quickly make sure that I inscribed that correctly. Minus s n to the minus d1. Okay, now we're going to plug in for that. So strike price 40. E to the minus, that was free rate is 8%. Time to expiration is 1/4 of a year. N of minus D2, we calculated that right up here. That's 0.412 minus the stock price. Where's the stock price? Stock price was 41. And I'm going to do N of minus D1, that's right up here. 0.355. Do this. And what do we get here? We're going to get $1, about $1.61.
Professor, are
Yep.
these prices at expiration or at time zero?
Time zero, right there at expiration. There's no price for an option. There's just what it expires at. So this is the equivalent. I guess I'm not using the C0 and P0, but this is the price right now of an option. So I've got a couple of minutes. Maybe I'll start into this. I don't know if I'll get through it, but I want to show you just a spreadsheet implementation.
Professor, is this the pricing model that is currently used today in the markets or not?
Yeah, oh, this is absolutely used. So I would say that there might be some variations on it, but this is, I mean, this forms the basis of just about all the pricing that's used in markets. When I say there might be some variations on it, what is the one thing that we don't know that we need to supply to this model, and that's the volatility. So that's really an option pricing where sort of differences come in between people's estimate of the value of an option. It comes in through the estimate of the volatility. But otherwise, option traders think in terms of this Black-Scholes formula. And we'll talk about the Greeks in a bit or whatever, and sort of how they use it and ways to help us give a little more insight into an option. But they really think in terms of this model. This is just so fundamental. Okay, I'm probably going to run out of time. So you know what? Instead, next time when I start, what I'll do here, just to sort of help with this, we can set up a spreadsheet implementation of this. It'll probably help with homework and things like that. Because like I said, my calculator doesn't have the cumulative normal distribution. So you see that in Excel. But the other thing we'll compare it against is, that 10 period binomial model, because this is the limit of the binomial model. So that 10 period binomial model, now that's not the limit as the number of steps go to infinity, it's only 10. And like I said, in practice, they're going to use something like 200. I don't have 200 steps set up, but I have the 10-step model. And so that should be pretty close to what we get here. So we can compare those two, and that should be an interesting comparison. So maybe I'll start with that next time. We'll set up the spreadsheet implementation so everybody knows how to do that. Then we'll compare it against the binomial model, which this is the limit of. All right, great. So I'm going to stop here. Like I said, we'll pick it up here next time. And I'll probably post a homework pretty soon. And next time we'll also be Zoom only, at least for this week. And then we'll have the Thanksgiving break and then come back in person. Yeah, was there another question? No. Okay. Okay, great. So I will see everybody on Wednesday. Oh, somebody asked, will the final be cumulative on here? And no, the final won't be cumulative. It'll be like another exam, like another midterm. Okay, great. I will see everybody Wednesday then.
All right, thank you, Professor. Bye.
Thank you.